Yeah, so as I said in my last session, today we'll be discussing chapter 13, that is taxation. So this is already there in your financial reporting, but in SBR it will be mainly focused from deferred tax perspective. So first we try to discuss the accounting treatment for current tax as well as deferred tax. Then we'll be discussing a SBR case study on deferred taxes. So the core discussion will be on the meaning of taxes, current tax, deferred tax, and we'll also try to understand what is the deferred tax asset, deferred tax liability, and we'll also be focusing on some specific scenarios. So here in this, as I mentioned earlier, we will be focusing on current tax and deferred tax. Now the current tax is nothing but the tax which is payable on the trading activities of an entity is considered as current tax. It means the business entities need to pay certain amount as tax on their trading activities. In simple terms, the business entity needs to pay tax on their profit. Now, generally, most of the tax authorities will be collecting around 30% as tax. So, the tax payable by the entity on their trading activities will be considered as current tax. And when it comes to the deferred tax, now deferred tax means this is nothing but the tax which is levied on the difference between the value as per the accounting base and as per the tax base. Because here you can see an accounting measure used to match the tax effects of transaction with their accounting treatment. So the tax expense for an entity is calculated. In simple terms, when it comes to the deferred tax, if you take depreciation as an example, now generally most of the companies will be charging the depreciation on straight line method or diminishing balance method. But when it comes to the tax authorities, they will be allowing the companies to charge the depreciation. It means the companies can charge higher amount of depreciation when the asset is new, and when the asset becomes old, the companies will be charging less depreciation. So when the asset is new, tax authorities will allow the client or will allow the entity to claim higher amount of depreciation, and when the asset becomes old, they will be charging less depreciation. There is no such treatment as per accounting rules. We may either use straight line method or accounting diminishing balance method to charge the depreciation. Now, why we are discussing the depreciation for this taxation? Let us assume that the carrying value of an asset as per accounting base is 1 lakh and the carrying value of an asset as per tax base is 80,000. It means the why there is a difference in the carrying value as per accounting base and tax base because of depreciation. Because as per accounting base, we charge only 20,000 as depreciation, and as per tax base, we charge 30,000 as depreciation. So there is a difference in the value of carrying value because of a differential treatment of depreciation. So the tax which is arise on these temporary difference. Now here why we assume it as a temporary difference? If you consider over a period of time, suppose if the life of the asset is 5 years, then we won't be charging an amount of more than the cost value. It means it won't be creating any permanent difference. It will be creating only temporary difference for that particular accounting year. So deferred tax will be always levied on the temporary differences. Now we try to understand this different deferred tax concept with a small illustration. Let me open my Excel sheet. Still now only one participant. I don't know why participants are not joining. Let us assume that the value, the cost of an asset is 1 lakh, useful life of asset 5 years, tax rate 30%. And as per tax breach, as per the tax authorities, following is the permissible amount of depreciation. So generally we say it as capital allowance, depreciation or capital allowance we say. So 5 years. So first year we can claim 30,000 as depreciation. Second year 25,000. Third year 20,000. And fourth year 15,000. And the last year 10,000. So these are the amount of depreciation as per tax. And as per accounting base, generally we use the formula that is cost of asset minus scrap value divided by life of asset. That is the formula for charges of depreciation. So as per accounting base, depreciation. So here cost of asset is 1 lakh, life of asset is 5 years. So we'll be charging 20,000 as depreciation. So now we try to apply this, how this will be affecting on the deferred tax. So the first thing is carrying value of asset as per accounting base. Then carrying value of asset as per tax base. Then temporary difference. Then deferred tax. Then the effect of deferred tax in our statement of profit and loss account and statement of financial. So as the carrying value of an asset as per accounting base. So here initially the cost of asset was 1 lakh, and if you deduct the depreciation of 20,000, then the carrying value of the asset will be 1 lakh minus 20,000. It will be 80,000, and the carrying value of asset as per tax base, that is initially cost asset 1 lakh minus the first year depreciation is given as 30,000. So here you can see in the first year, at the end of the first year, the carrying value of asset as per accounting base is 80, and the carrying value of an asset as per tax base is 70. So there is a temporary difference of 10,000, and the deferred tax will be calculated on the temporary difference. So here we got a temporary difference of 10,000, and the tax rate is 30%. So the deferred tax would be 10,000 into 30%. And in the statement of profit and loss account, we will be considering this, we will be adding this 3,000 to the provision for tax. So this 3,000 we will be adding it to the provision for tax in the statement of profit and loss. the statement of profit and loss account. And in the statement of financial position, we'll recognize this 3000 as deferred tax liability. So 3000 will recognize it as deferred tax liability in our statement of financial position. So this is the treatment for the first year. So once again I will repeat. At the end of the first year, the carrying value of an asset is 80,000. This is as per accounting base. So because the cost was 1 lakh, and if you deduct the depreciation, annual depreciation of 20,000, the cost carrying value is 80. And as per tax base, 1 lakh, that is the value of the asset, minus depreciation, that is 30,000 as per tax base. Then the carrying value will be 70,000, and there is a temporary difference of 10,000. So I already mentioned at the beginning of the session that deferred tax will be calculated only on the temporary difference. So in this case also there is a temporary difference of 10,000, and if you multiply or if you apply 30% tax rate on the temporary difference of 10,000, then we will be getting a deferred tax of 3,000. And this 3,000 deferred tax, we will be adding it to the provision for tax in the statement of profit and loss account, and we recognize it as a deferred tax liability in the statement of financial position. So this is for year 1. Now when it comes to the second year, so the carrying value of the asset would be 80,000 minus second year depreciation 20,000, then it will be 60,000, and the carrying value of the asset as per tax base, that would be 70,000 minus second year depreciation. So here second year capital element is given as 25,000. So it is 45,000. So carrying value of the asset as per accounting base is 60,000, and the carrying value of the asset as per tax base is 45,000. So there is a temporary difference of 15,000. So here if you observe the previous year end, the temporary difference was only 10,000. But when it comes to the year 2, the temporary difference is 15,000. Now if you calculate the deferred tax on this temporary difference of 15,000, then it will be 15,000 into tax rate 30%. So it is 4,500. So the deferred tax, if you compare with the last year, it was 3,000. Now it is 4,500. So it increased by 1,500. So deferred tax has been increased by 1,500. So in the statement of profit and loss account, we will be adding 1,500 to the provision for tax. And in the statement of financial position, we recognize 4,500 as deferred tax liability. So this is the second year treatment. So participants, if you have any query on the first year treatment and the second year treatment, let me know. Then we'll go for the third year. Now the third year, the carrying value of asset as per accounting base would be 60,000 minus the third year depreciation 40,000. Then it would be 40,000, and the carrying value of the asset as per tax base would be 45,000 minus the capital elements for the third year, that is 20,000. So it is 25,000. So again here there is a temporary difference of 15,000. So there is no change in the temporary difference for the third year compared with the second year. So the deferred tax amount will also be same, 4,500. So in this case, there will not be any entry in the statement of profit and loss account because there is no movement of deferred tax for the current year. And when it comes to the statement of financial position, we continue to recognize the deferred tax liability as 4,500. So this is accounting treatment for the third year. So the reason for not posting any entry in the statement of profit and loss account is there is no movement in the deferred tax. It means as per IAS accounting standard, here you need to understand that the deferred tax will be charged in the statement of profit and loss account only in case of movement. If there is no movement, there will not be any effect. But in case of statement of financial position, we continue to recognize the deferred tax liability. So if you have any query on the third year, let me know before I go to the next one. Then the year 4, now here for the carrying value would be 40,000 and the current year depreciation 20,000. Then carrying value as per tax base would be 25,000 and the capital elements for the fourth year is 15,000 and the temporary difference will be 10,000. So the temporary difference has been decreased because previously it was 15, now it decreased to 10,000. Now if we calculate the deferred tax on this 10,000 into 30%, then the deferred tax is 3,000. So here the deferred tax amount has been decreased. It was decreased from 4,500 to 3,000. So in the statement of profit and loss account, we will deduct 1,500 to the provision for tax. And in the statement of financial position, we will be recognizing the deferred tax liability as 3,000. So this is the accounting treatment for the fourth year. And for year 5, so there will not be any carrying value. So 20 minus 20. So the carrying value will be nil as per accounting base. And as per tax base also the carrying value will be nil. And there is no temporary difference. So if there is no temporary difference, there will not be any deferred tax. But in the statement of profit and loss account, whatever we already created the deferred tax liability of 3,000, now we need to deduct 3,000 to the provision for tax. And in the statement of financial position, there will not be any deferred tax liability. So this is the accounting treatment for deferred tax in your statement of profit or loss and in your statement of financial position. So in simple terms, you need to understand. So deferred tax is calculated on the temporary difference. And here the temporary difference is nothing but the difference between the carrying value of an asset as per accounting base and as per the tax base. Now, as per the movement of deferred tax, we will be charging it in the profit or loss account. If the deferred tax increases, now generally we add that particular increased amount to the provision for tax and we will be recognizing the total deferred tax liability in the statement of financial position. And if the deferred tax decreases, then we will be deducting it to the provision for tax in the statement of profit and loss account and an equivalent amount will be deducted in the liability of the statement of financial position. And we should also understand the deferred tax asset and the deferred tax liability. So what exactly this deferred tax asset and deferred tax liability? So deferred tax asset. Now deferred tax asset is nothing but tax on taxable temporary difference is known as deferred tax asset. So tax on taxable temporary difference. Taxable temporary difference is known as deferred tax liability. It is known as deferred tax liability. And when it comes to the deferred tax asset, Now, deferred tax asset will be charged on deductible temporary difference. Now, here you should understand this. So, deferred tax liability means tax on taxable temporary difference is known as deferred tax liability, and deferred tax asset means tax on deductible temporary difference. So, tax on deductible difference. Now, when will this taxable temporary difference and the deductible temporary difference come? Suppose if it is an asset. Now, in case of asset, if the carrying value of an asset as per accounting base is more than the carrying value of an asset as per tax base, then we consider it as taxable temporary difference. Once again, I repeat, if the carrying value of an asset is more than the carrying value of an asset as per the tax base, we consider it as taxable temporary difference. And if the carrying value as per accounting base is less than the carrying value as per tax base, we consider it as deductible temporary difference. And in case of liability, if the carrying value of a liability is less than the carrying value of nothing but if the carrying value of a liability as per accounting base is less than the carrying value of a liability as per tax base, then that is considered as taxable temporary difference. And if the carrying value of a liability as per accounting base is more than the carrying value of the liability as per tax base, then we do consider it as taxable, sorry, deductible temporary. So before we go with a case on deferred taxes from our SBR, if you have any query, let me know. If you have any questions on this, let me know. Yeah. So as I said, we'll be discussing a case on this. Yeah. So I hope you can see this page. You can see my Word document. So following is the statement of financial position relates to Kesari Group, and this particular company is a public limited company at 30th June 2006. So here we can find the assets, non-current assets, that is property, plant and equipment is given $10,000, goodwill 6,000, and other intangible assets 5,000, and finance asset at cost 9,000. Trade receivables are given 7,000 and other receivables 4,600. Cash and cash equivalents is 6,700 and the total assets value is 48,300. And here we can find equity and liabilities. In that, the first one, share capital, that is 9,000, other reserves, retained earnings, and under non-current liabilities, long-term borrowing 10,000 and deferred tax liability 3,600 and employee benefit liability is 4,000 and the total non-current liabilities are 17,600. And the current tax liability 3,070 and the tax and other payables 5,000 and total liabilities and total equity and liabilities. So this is the statement of financial position, and they also gave certain adjustments. Now, if you see the first adjustment, the financial assets are classified as fair value through other comprehensive income, but are shown in the above statement of financial position at their cost on 1st July 2005, including the transaction cost of 0.5 million. So the market value of the asset is 10.5 million on 30th June 2006, and the taxation is payable on sale of assets. So I hope you might have recollect this when we were discussing about the financial instruments, especially when it is relating to the financial asset. So we can recognize or we can measure the financial asset as per fair value through other comprehensive income or fair value through profit or loss. But in this question, the financial assets are classified as fair value through other comprehensive income. But when it comes to the accounting or nothing but in the statement of financial position, instead of showing this at its fair value, the company showed it at its cost. Now here you can see, because in the question financial assets are shown as cost. But as per IFRS 9, if it is measured through fair value through other comprehensive income, we need to show it at its fair value. And its fair value at the end of the year, that is on 30th June 2006. So the fair value at the end of the year, that is 30th June 2006, is 10.5 million. Now the stated, this is the first adjustment. So here do remember in the statement of financial position, it was given at its cost. But as per IFRS 9, we need to show this financial asset at its fair value, that is 10.5 million. And the second adjustment is the stated interest rate for the long-term borrowing is 8%. And the loan of 10 million represents a convertible bond which has a liability component of 9.6 million and an equity component of 0.4, and the bond was issued on 30th June 2006. So here under the non-current liabilities there is a loan and this is a convertible loan. Now again, as per IFRS 9, if you can recollect, convertible loans are considered as compound instruments. So in case of compound instruments, we need to apply split accounting where we need to separately recognize the debt component under the non-current liability and equity component under other components of equity. But when it comes to this particular case, it was not shown like this. It means that the total value is there. So it includes a debt component of 9.6 and equity component of 0.4. And the defined third adjustment, the defined benefit plan had a rule change on 1st July 2005. Now the company estimates that of the past service cost, 1 million, 40% relates to the vested benefits and 60% relates to the benefits that will vest over the next 5 years from the deed. And the past service costs have not been accounted for. Now here the defined benefit plan, the company decides to change the rule of the defined benefit plan. They are operating a defined benefit plan. Now the company wants to change the rule. The company estimates that the past service cost of 1 million. Now this 1 million is equivalent to 40% relates to the vested benefit and 60% relates to the benefit that will vest over the next 5 years from the date. And they also mentioned that the past service costs have not been accounted. So if it is not accounted, so as per accounting standard 19, employee benefits, we already covered that particular chapter. So as per that, if any past service component is there, we need to include it in the financial statement. But here the company didn't recognize it. As the next adjustment, the tax base of all assets and liabilities are same as their accounting treatment in the statement of financial position at 30th June 2006, excluding the following transactions. So in that, the first exclusion is property, plant and equipment. So the property, plant and equipment as per tax base is only 2,400, and the trade receivables as per tax base is 7,500, and other receivables is 5,000 as per tax base, and employee benefits as per tax base is 5,200. And other intangible assets were development costs which were all allowed for tax when the cost was incurred in 2005. So it means other intangible assets, it is related to development expenses. So I hope you can recollect IAS 38. If the development expenses satisfied certain criteria, then the company can capitalize the development expense and they can recognize it as an intangible asset. But there is no such treatment as per the tax authorities. We cannot capitalize the development expense. We need to charge it as an expense to the statement of profit and loss account, but not as an intangible asset to the statement of financial position. And the next adjustment, trade and other payables includes an accrual for compensation to be paid to employees, and this amounts to 1 million and is allowed for taxation when paid. So trade and other payables includes an amount of accrual that is 1 million. So as per the tax authorities, it should be allowed when it is paid. And the next adjustment is goodwill is not allowed for tax purpose in this jurisdiction, and we should assume the tax rate is 30%. So before we go with the discussion of this question, once go through the adjustment. So I'll be giving 2 minutes time. Please go through the adjustment. Yeah. So we'll discuss how to calculate. So here the requirement is, so first one is a knowledge based question. It is what is the conceptual basis for deferred tax ation. The second one, calculate the provision for deferred tax on 30th June 2006 after any necessary adjustments to the financial statement, showing how the provision for deferred tax would be dealt with the financial statement. So we need to calculate the provision for deferred tax as on 30th June 2006. So I will be explaining it in Excel sheet. So here the requirement is computation of provision for deferred tax as on 30th June 2006. I hope everyone can see my Excel sheet. So in order to calculate that, first we need to compare the value of assets as per the accounting base and the as per tax. So first we try to see what is the value of asset as per accounting base. We'll start with non-current assets. So under non-current assets, the first asset is property, plant and equipment. So property, plant and equipment as per accounting base. So the value of property, plant and equipment as per accounting base, they gave it as 10,000. And as per tax base, now as per tax base, we'll see the adjustments. So the value of property, plant and equipment as per tax base, they gave it as 2,400. So next is temporary difference. So here the difference, the temporary difference, 10,000 minus 2,400. So it is 7,600. Now here you should understand whether it is a taxable temporary difference or a deductible temporary difference. So as I already mentioned, if the value or the carrying value of an asset as per accounting base is more than the tax base, we assume it as taxable temporary difference. In this case also, the value of property, plant and equipment as per accounting base is 10,000 and as per tax base is only 2,400. So we got a taxable temporary difference, that is 7,600. Now after PPE, the next item is goodwill. So in the adjustments already they mentioned that the goodwill is not considered for the, here you can say, goodwill is not allowed for tax purpose in this business. So because the goodwill is not allowed, so we won't be considering the goodwill value. So after goodwill, next asset is other intangible. So other intangible assets. So as per accounting base, so there is an adjustment. We'll see whether any adjustments are given for this. So as per accounting base, it is 5,000, and in the adjustment, so other intangible assets for development costs which were allowed for tax purpose when the cost was incurred. Now here you need to understand that as per IAS 38, if development costs satisfy certain criteria, we can recognize it as an intangible asset. But there is no such recognition as per the tax base. We cannot recognize a development expense as a intangible asset. So as per accounting base, it is 5,000 and as per tax base, it is 0. That is nothing but nil. So again, there is a temporary difference of 5,000. So why we are not considering the value of intangibles as per tax base? Because development expenditure cannot be capitalized as per tax. So that's why we are assuming it as 0 and the temporary difference is 5,000. Then after other intangible assets, next item will be then financial assets. So the next heading is financial assets. So financial asset, actually it was stored at its cost, that is 10,000. The financial assets were stored at its cost, that is 10,000. But do remember, as per IFRS 9, financial assets should be shown at its fair value. So in the book, the fair value of the asset in the adjustment they gave it as, so this is your first adjustment. The financial assets are shown at its cost, but we cannot show at its cost as per IFRS 9. We always need to recognize the financial asset at its market value, that is at its fair value, that is 10.5. So in the accounting base, we need to recognize it as 10,500, and as per tax base, we continue to recognize it as per their cost base, that is 9,000. So again, there is a temporary difference of 1,500. So this is for financial assets. Then after financial assets, so the next asset is trade receivable. Trade receivable. So the trade receivables as per accounting base, they gave it as 7,000. Trade receivables as per accounting base is 7,000. And we'll see as per tax base. So as per tax base, trade receivables are 7,500. Now here you can understand, in the previous cases, the carrying value as per accounting base was more than the carrying value as per tax base. So that's why we assumed it as a taxable temporary difference. But in this case, in case of trade receivable, the value as per tax base is more than the accounting base. So we assume it as deductible temporary difference. So we will be showing it in. So here do remember 500 is nothing but deductible temporary difference. Why we are showing it is minus? Because it is, in this case, the tax base amount is more than the accounting. So this is about trade receivable. Then the other item is other receivable. So the other receivables as per accounting base is 4,600. And as per tax base, it is 5,000. So in this case also, the tax base amount is way more. So we'll be showing it in line. Then so cash and cash equivalent, we won't be considering cash and cash equivalent. We will be leaving that. Then is liabilities. So under the liabilities, the first one is non-current liability, that is long-term borrowing. So this long-term borrowing, there is an adjustment for this. First, we'll try to see the adjustment. So the stated interest for long-term borrowings is 8%, and loan of 10 million represents a convertible bond which has a liability component of 9.6 and an equity component of 0.4 million. So it means as per IFRS 9, in case of compound instruments, we will be recognizing the debt component and only debt component should be shown under the non-current liability. So as per accounting base, we will be showing it as 9,600. But as per tax base, whatever the issue proceeds are there, so the total issue proceeds we will be recognizing in our tax base. Now in this case, long-term borrowings is nothing but a liability. So here the carrying value of this long-term borrowings as per accounting base is 9,600 and the carrying value of long-term borrowings as per tax base is 10,000. So the tax base amount is more. So because it is a liability and if the tax base is more than the accounting base, we assume it as taxable temporary difference. So here the difference amount is 400. So this is about the long-term borrowing. Then next. Then deferred tax liability. So we finally at the time of calculating the deferred tax provision, we will consider this tax liability. So present we will be leaving it. Next is employee benefit liability. So employee benefit liability in the statement they gave it as 4,000, but there is an adjustment for employee benefit liability. So here you can see the defined benefit plan had a rule change on 1st November 2004 and there is a past service cost of 1 million which was not recognized. So as per the accounting standard employee benefit, if any past service cost is there, we need to show it in the financial statement. Then the total deferred benefit liability will be 4,000 plus 1 million, it will be 5,000. And as per tax base, it is 5,200. So again, there is a taxable temporary difference of 200. This is about employee benefit liability. Next. Then current liabilities under the first one, current tax liability is 3,070. Here there is no change in the current tax liability. So current tax liability as per accounting base is 3,070 and as per tax base also 3,070. So there is no effect in the temporary difference. And next one is trade and other payable. So trade and other payables as per accounting base is 5,000 and as per tax base will see the adjustment for this. So here we can see the trade and other payables include an accrual for compensation to be paid to employees and this is 1 million and is allowed for taxation when paid. So it means that we cannot consider total 5 million for as per tax base because 1 million is outstanding. It should be recognized in tax when the company incurs this. So in that case, we need to recognize only 4,000. And now in this case, trade payables, so the carrying value of trade payables as per accounting base is more than the carrying value of trade payables as per tax base. So this is considered as deductible temporary difference. So we will be showing it in minus. So the temporary difference is. Now we done with all the adjustments. So next is total taxable temporary difference. So the total taxable temporary difference will be 7,600 like 5,000, like 1,500, like 400, like 200. So the total value of taxable temporary difference is 14,700. Then total deductible temporary difference. So the total deductible temporary difference will be 500. Let's put, yeah, 400 plus 1,000. So the total temporary difference is 1,900. So the net difference. So here we are getting taxable temporary difference only because taxable temporary difference amount is more than the deductible temporary difference. So we will be getting net taxable temporary difference, that is 14,700 minus 1,900. So we got total 12,800 as net taxable temporary difference. On this, we will be calculating the deferred tax. So the deferred tax, that is 12,800, and the company tax rate is 30%. So the deferred tax for the current year should be 3,840. So from this 3,840, we will be deducting the deferred tax opening value. So in the statement of financial position, they already gave the deferred tax opening value. So the deferred tax value is 3,600. Deferred tax opening value is 3,600. So it means that the deferred tax has been increased by 240. So this 240 will be adding to provision for tax in the statement of profit and loss. In statement of profit. So this is the treatment of. So if you have any query on this, list. If you have any queries on this, let me know. Okay, so that's it. The next topic we'll be discussing in the next session. So I won't be continuing. So next topic we'll be discussing in the next.